This episode of Balancing Acts, we want to focus on some year-end tax planning, kind of getting ready for the fourth quarter and 2025. So we have a very special guest with us today, Alana McNichol, who I have worked with for close to 20 years. Alana is the director of our tax practice services. She's an MBA and a CPA. She's passionate about helping small businesses, nonprofits, and individuals thrive through smart tax and accounting decisions. She's also proficient in cloud accounting technology and loves to help her clients implement software to reduce operational friction, which many find. She's volunteered at a number of nonprofits, including the chairing the Entrepreneurs Committee of the Financial Women's Association. She's a member of the National Association of Tax Professionals and the New York State Society of CPAs. Welcome, Alana. It's great to have you here with us, helping business owners today.
Thank you so much. It's an absolute pleasure to join you.
And so the first topic I want to talk about is just, let's talk about compensating yourself. All business owners have to pay themselves. And there's different types of entities. There's S corporations, sole proprietors, LLCs, and partnerships. So can you talk about the key differences in how an entrepreneur should pay themselves depending on their business structure?
Well, you hit it at the beginning of this question, which is really entrepreneurs should pay themselves. I was speaking with an entrepreneur last week, actually, and she had a budget for her business that she was trying to launch, and paying herself wasn't even a consideration in that budget. And we all have passions, we all have products, we all have visions that we want to bring to market, but we're also looking to get paid, right? So, I mean, I think don't lose sight of that as a business owner, as an entrepreneur. So now diving into kind of the nitty gritty on taxes, like you mentioned, Linda, we've got sole proprietors, we've got LLCs, and we've got S corporations, which are sort of the main buckets of how your business might be structured. So a sole proprietor, we're either unincorporated or we've got a pass-through entity where there is no separate tax return filed. Everything shows up on your personal tax return. And then in an LLC or an LLP, you've got a business entity and you have probably more than one partner. And finally, in an S corporation, you're incorporated, and then you filed an election to be an S and report things on your personal tax return. So as a sole proprietor, you can take money out whenever you want, and it's not going through a salary, right? It's simply a draw on the company. And the same is true for an LLC or an LLP versus an S corporation, where it is truly a wage, right? So you're getting a W-2. When you are taking a salary from an S corp, you're sort of treated more like an employee despite being the business owner.
Right. And you actually are an employee. And actually C corporations, there might be some people listening who are organized as a C corporation, a regular corporation, instead of an S corporation, which is for tax. And they too are treated as employees. So how about the tax implications of a different method? Why don't we focus on S corporations for a moment? How do they take that? How do they decide what the salary should be?
Yeah, it's a great question. And one of the reasons that it's a focal point for us right now is that the IRS is focusing more heavily on S corporations and compensation in particular. So when you are an S corporation, you need to pay yourself what is called a reasonable salary. And a reasonable salary conceptually is how much would you pay an employee to do the work that you are doing, right? So if you were hiring somebody to do the job that you are doing as the company owner, what would the salary be? And that is not just picking a number based on how much money you're making, for example, right? That is actually, what are my job duties? What are they worth? And that is what your reasonable salary should be. And I think one of the things that S Corp owners don't necessarily understand is they cannot take money out of their S Corp unless they have paid themselves that reasonable salary, right? So if your reasonable salary is $100,000, you've got to pay yourself on a W-2 that dollar amount before you start taking money out in other ways, such as a distribution.
Right, right. And distributions, for those of you listening, means taking money out. Sometimes your accountant will call it a distribution or a draw, but essentially you didn't take any payroll taxes out of it. There's no withholding. You've just taken the funds out. And clearly that that can create a problem. What happens if you take distributions and you haven't taken a reasonable salary yet? What's the consequences of that?
Well, and when we talk about distributions, it's not always just pulling money out of a bank account. Some S Corp owners will randomly pay a personal bill through their S Corporation or do some other kind of fund commingling transaction that ends up being looked at the end of the year. So the IRS will come in and say, hey, these distributions that you took tax-free should have been salary. And they will actually penalize you for not paying yourself salary. And of course, for not paying in payroll taxes. The government wants their Social Security and their Medicare, and they will penalize you if you don't actually pay into the system through a salary. So it's really, again, enforcement is looking at this a lot more closely than they have in the past. I have heard from other practitioners that they're seeing this be challenged on a federal level.
Right. So they're challenging. We think you shouldn't have taken that much distributions. It really should be salary instead. And that's what's important to talk to your own accountants about. So the last thing I want to ask about this same topic is, okay, I've decided my salary should be $60,000 and, I wanted to take 20,000 in distributions. How do you keep a record of the 60? What do you need? Do you need a piece of paper? Do you need an agreement? What should you do to actually document that?
Yeah, so what we do in our practice is we actually use a piece of software that generates a reasonable compensation study. And that is based on a detailed interview that we do with a business owner to understand what they're doing for the company. And of course, when you're the business owner, it's not just working on the company, it's also working in the company, right? So you may be managing the company and doing the work to deliver the services that you're providing. And it is about having substantiation. It is about having a document in your records contemporaneously, right? You're setting that salary. Ideally, you're setting it every January, right? New year, what's going on in the company? Am I doing something different? Should that change my compensation structure? So you need to put some thought into this. And I think it's very easy to just say, I'd like to make 100K this year. But it's a lot deeper conversation than just pulling out a number that sounds good to you.
Right, right. And then as you mentioned, as long as you don't take distributions, there really aren't any consequences to taking less because your salary is already the most the company can pay you. What about LLCs?
That's the other side to this is that if you don't have the profits to take the salary, then you also don't have a problem, right? It's that you're taking cash out of the company and you're not putting it through payroll and you haven't hit your reasonable salary number, right? That's when you're going to have an issue.
What other benefits would you like to mention that business owners can take, whether they're S Corps or LLCs? What can you recommend?
Yeah, we did a deep dive onto S Corps here, but in terms of benefits, I think what I really hate to see is that people who start a company, own their own company, are not funding their future. And of course, I'm talking about retirement benefits. When you're a W-2 employee, it's very easy to just check the box and say, yes, start funding my 401k, right? And it's sort of a set it and forget it. And you are truly creating benefits for your future self. And I think when you're a small business owner, you've got to be thinking that way. I mean, the great thing about owning a small business is that there are many different kinds of retirement accounts that you can think about. But this is a conversation to have with your advisor sooner than later. I think setting the habit, making it part of the way you think about your own compensation is really important.
Yes, I completely agree. Anything you want to say about LLCs on how they get paid, especially maybe if there's a partner? If a single member LLC is more like a sole proprietor, but what about if there is more than one owner? Do they have to follow any specific rules like S corporations do?
Sure. So an LLC or an LLP, when you have partners, you're not getting a salary in the same way, right? You're not getting a W-2, you're not getting a paycheck, you're not paying into the payroll system. You are taking money out of the company. It's usually called a guaranteed payment, and it is subject to self-employment taxes, right? So that's, a difference structurally than on the employee side. And I think on that note, tax planning wise, a lot of my clients who are in a partnership structure don't always think about paying into the system as they go in a way that a W-2 paycheck does, right? So you are self-employed, you're responsible for those self-employment taxes. You've got to think about where you're going to end up in the year, and you've got to pay in quarterly. And I think we hear about those surprise tax bills because business owners really aren't looking at the big picture of how they're taking money out and how it will be taxed.
Great. We're going to take a commercial break in a moment. I just want you to remember from this segment, if you're an S corporation or a C corporation, you want to make sure you have a method of documenting your salary to avoid penalties and understanding the difference. Have a conversation with your accountant. Make sure they explain this to you. And we'll come back and we're going to talk about reporting beneficial ownership and the new Corporate Transparency Act. Welcome back to Balancing Acts. We're talking with Alana McNichol, a CPA and the Director of Tax Practices for Linda Hamilton CPA LLC, based in New York City, but working with customers across the country. Alana, we want to talk a little bit. There's so much buzz right now about the words beneficial ownership or the CTA or the, the Corporate Transparency Act. Can you walk us through why it's important for us to talk about that today? What is important about 2024?
Yeah, beneficial ownership reporting. It is a seemingly simple reporting requirement that we're finding out very quickly has layers of complexity. And unfortunately, that's sort of the name of the game with Congress deciding what they want to do and when they want to do it. And, it's up to us as professionals and you as business owners to figure out how to cross your T's and dot your I's. So conceptually, the beneficial ownership reporting is a report that tells the government for every entity out there who owns it or substantially controls it. And all you have to report on that is the name, the residential address, the date of birth, and a copy of a photo ID. So on its face, okay, not so bad. That being said, there is a lot of nuance on ownership, substantial control, who needs to be reported, when the report needs to be updated. Unfortunately, the list goes on and on.
So when we talk about control, and you might think, well, I own the company and that's it. I'm the only owner. But it's more than that, right? Sometimes there can be an employment agreement or there can be other things. So why don't you walk us through a little bit of what does that control mean and what positions might fall under that category that they should be aware of?
Yeah, so unfortunately, ownership is just kind of the tip of the iceberg about what you need to consider when you are considering reporting under the beneficial ownership requirements. We're talking about the C-suite, corporate officers, your general counsel, perhaps, other senior executives. and really important decision makers. Again, this is a very broad term. Um, and it's not particularly well defined, which is why we are encouraging our clients to seek out counsel when they fill out this report. So, substantial influence. Do you have decision-making capability about the business, the finances, the structure of this organization? You know, for a lot of us, it's quite a simple answer, but it still requires some thought. You really need to just go beyond who owns this company on paper and think hard about who has that kind of influence within your business. And I think it's you report now on what's going on today, but you also have to report in the future if this changes. So, I mean, how often does the C-suite change? More frequently than you might think. So you've got to spend some time with this legislation.
So there's a couple of nuances. We're not attorneys. We're accountants are always working closely with attorneys to help their clients understand the requirements. One thing I want to make clear is this is a FinCEN form. It's not a tax form. So it isn't necessarily prepared by your accountants and shouldn't necessarily be prepared. If CPAs are listening to this and you're a small CPA firm, it has been ruled, I will say the New Jersey Committee on the Unauthorized Practice of Law ruled that no one should be preparing these forms except lawyers. And they carved out a tiny little exception for CPAs and enrolled agents. And they said, only if it's simple can your CPA help you. If it's complex, your CPA cannot. So, you know, what might be an example of something complex? Alana, is that part of the reason we've decided together to say this is something that lawyers need to read through all your documents, your employment agreements, your operating agreement, your bylaws. Somebody has to read through all those documents to actually figure out whose name has to be listed on this form. What can you add about that on how you're maybe working with law firms in New York City?
Well, we've got an exclamation point around this entire issue because the penalties can be up to $600 a day for doing this incorrectly. Which, you know, as a small business owner, that's a massive amount of money for what is just a form. There's no tax liability associated with this form. It is truly just a filing requirement. But that's the reality. And so we are talking to clients about the structure of their business. I mean, I think a lot of businesses are very simple, right? There's one owner. That's kind of the end of the line. But something that a client asked me recently is, well, I'm one business owner. I own the company, but I file a tax return with my spouse. They're reported on that tax return. Do I need to be thinking about them? Or, you know, I have a management agreement with somebody in my LLC. I think I manage it and they don't, but what does that actually, how does that actually relate to what are in my documents, right? There's a distinction between how you are operating today and what are in your agreements. And that is what some of this is getting at, is that substantial control is actually quite subjective, which is, again, nobody likes to pay more in legal fees than they have to. But when we hear $600 a day penalty, we sometimes have no choice but to say, hey, you've got to talk to counsel about this one.
And I think it's particularly helpful to maybe at least talk to the lawyer this year, get somebody to go through your documents. It's not even a bad time to update all your corporate records. Is your operating agreement clear, or is it something you looked at 15 years ago? Are your bylaws clear? Or again, did you maybe use LegalZoom to create your company and nobody really looked over it? So this is a good time to maybe do some housekeeping. What happens if you dissolved your entity sometime in 2024, and this form is due when? It's due December 31st. And you might talk about the due dates a bit. for new entities and former entities?
Yeah, so if you form a new entity, you have, I believe it is 60 days from the date that you form the entity to file this initial report. And I should also point out that not only do you have to include the beneficial ownership information on a new entity, you also have to include the name of who helped you form the entity. So if you worked with your accountant to form this entity, you may have to list them. And I want to also clarify that we're talking about personal information, right? You are supposed to be listing personal residential information for some of these filings. So it's something to think through perhaps before you form. But otherwise, all existing entities have to file this, yes, by December 31st of this year. And if you're in the process of winding down a business, you may still have to file this for an entity that is in the process of dissolving. Are you truly considered dissolved? Has the state rubber stamped that yet? Is the bank account gone? I mean, I think a lot of professionals out there are sort of giving it a when in doubt, file it kind of mindset, which I don't think is necessarily a bad one.
Yeah, I listened to a podcast the other day between several attorneys, and they had said that, the problem with dissolution is you aren't really dissolved on the date the state did. It follows state laws, and you might keep $2,000 in the bank account for any winding up expenses, but then there might not be anybody to sign. Again, these are these little nuances that can really kind of mess you up. And again, I think very helpful to speak to an attorney who can read the forms with you and make sure that you're doing what you need to do. You mentioned the penalty of $600 a day, which is quite significant. And the government often puts very large penalties on forms that are just informational. There's no tax liability. There's no cost to filing it. And that's why they do this, is to force compliance. So how does that $600 a day work when it comes to all of us? Maybe we formed our company 20 years ago. When do we have to file, and what kind of penalties would we have if we don't file it?
Yeah, I mean, it's the same basic concept, right? Whenever you formed, you still got to put something on record before the end of 2024. And the penalties are calculated in a couple of different ways. So I don't want to necessarily get granular on those calculations, but I think it's just more important for you to understand that there are, to your point, a ton of, right? This is a new, big, bad, scary one, but there are a lot of little compliance type forms out there that can bite you. And so I think, to your point about housekeeping, it's a great time for you to look at all of your documents. Are you in compliance with whatever the state wants you to do on an annual basis? There are a lot of things that I think seemingly have no consequence, but have those penalties attached to them.
Right. So we're going to take a break in a moment. I just want to summarize what you heard is Alana and I have decided in our firm that we want all of our clients to speak with an attorney, especially for this filing, because we want someone to be able to go over all their corporate documents, make sure they're in order, that the forms agree with what you think is the ownership structure and the operating agreement, and not to get in trouble. But we all have to file by December 31st. So you need to do this now. Let's not wait until December and, oh my goodness, I have to file this and I've got 3 days to file it and no one to help me. So take care of it now. Set up an appointment, meet with somebody in September, and get this taken care of. We're going to take a commercial break, and we're going to come back and talk to Alana more about how you can vet and work with an accountant or a bookkeeper. Welcome back to Balancing Acts. We're talking with Alana McNichol, a CPA and the Director of Tax Practices here in my firm in New York City. So we want to talk now about our audience about how do you hire an accountant or a bookkeeper? How do you vet them? How do you know what works best? Alana, what would you say are the most important qualities to look for when you're hiring? Why don't we start with a bookkeeper for your business?
Linda, I cannot tell you how often I have this conversation with business owners. How do I find a bookkeeper? How do I find a good bookkeeper? It is for a business owner, it can be a difficult role to hire for, right? I mean, often you're looking for a contractor, and it's a tough one to vet. If you're an entrepreneur, you're not really focused on bookkeeping, nor should you be. And therefore, it can be hard to evaluate somebody when you're interviewing a bookkeeper. I think, in my experience, there are a couple of things to look for when you're finding a bookkeeper. Asking your tax pro, do they know anybody, is certainly a good place to start. But I think you want to look for somebody who has years of experience, first of all. I mean, you can post I'm looking for a bookkeeper on, Indeed.com or one of these other online marketplaces. But I do think you need to have a conversation where you understand how long that person has actually been in business. And then, of course, you want to make sure they understand whatever software package you are using. Are they certified in that software? How long have they been using that software? And then I think also, are they working with other clients in your industry? The bookkeeping for a consulting business is very different than the bookkeeping for a manufacturing business. And those two industries are really not interchangeable. So you want to take your time, you want to interview, you want to ideally ask for references, right? I mean, you really want to get a good sense of this person's experience. Because what we find, Linda, in our practice is that when a bookkeeper is hired and probably not properly vetted, things get messy at year end. We are cleaning up the mess that somebody else made, and the business owner had no idea that the mess even existed, right? So it's a tough role to hire. I will say that.
Yes. And I think another thing they need to do is to set a budget for it, right? They need to know, do they want just a bookkeeper, or do they want the bookkeeper to do their filing? Do they want their bookkeeper to kind of be the office manager? And, I've been teaching workshops for many years to business owners. How many of them say, "Oh, I do my own books"? That doesn't mean you're a very good bookkeeper. So that you're probably not necessarily the best person to do that. But you have to really know what your budget is for hiring, how much experience they need to help you. Otherwise, you might just be getting a more clerical person. To your point, Alana, of saying how much experience they have and what do they really need there. What about in terms of hiring an accountant? How do they vet an accountant, which, may be hard to do, especially do they need a CPA? What about an enrolled agent? There are different types of professionals who do work with business owners, especially if it's only for taxes.
Yeah. So, I mean, accountants, right, is kind of a broad term, right? There are many different kinds of accountants. I think when people will say to me, I need a CPA. And I'll think, do you? What are you actually looking for, right? I mean, there are excellent tax professionals who are not CPAs. There are excellent CPAs who don't do tax work, right? So, I mean, understand what you actually need. And that can be hard for you to suss out as an entrepreneur, right? So an accountant ideally is somebody who is looking at your financial statements with you, who is perhaps also handling the tax side of things. But I think the way to understand it is that bookkeeping is entering your data, right? Accountant is reviewing that data with you, ideally, and then of course it flows into your tax work as well. But I think you need to try to have a mindset of, can we work together on my business, right? I mean, unfortunately, I would say probably the number one reason that people come into my door is that they're having trouble getting their CPA on the phone. They're having trouble getting a response about their questions, or their CPA is telling them, their accountant is telling them, I don't do that. I can't help with that. They're feeling scared to ask questions because they don't want to be lectured at, or, they're feeling like their questions are dumb. And I think the baseline skills are important, but communication style is also mission critical for an entrepreneur working with an accountant.
Yeah. If you're afraid to ask your accountant something because you feel stupid or they won't get you the answer, that's how you don't, things go wrong with your business. You need someone that's comfortable. It's not unlike going to a doctor. If we can't ask questions, we're not really being able to we have to feel very comfortable asking professionals who serve us to give us guidance. So what kind of guidance, how can somebody determine how much guidance they require from their accountant or their bookkeeper?
Yeah, so I do think you have to know yourself a little bit, right? I've spoken to entrepreneurs who keep a very tight lid on what their margins are, what their profitability is, how quickly they're turning over whatever KPIs they're focused on. And I have some entrepreneurs in my realm that aren't even thinking about numbers at all, right? So you need to do a baseline for yourself as an entrepreneur. How in touch am I with these things? Because that will sort of dictate what kind of support you're looking for. That being said, you should ideally find an accountant who can look at your numbers with you. We like to say quarterly is a good cadence. And what are you looking at? Well, you're sitting down with them and they're going through what they're seeing on their reports and discussing it with you. Hey, your profit is up. Your profit is down. Your accounts receivables are up, down. Do you know why? What's going on, right? And sometimes it will be a conversation where they identify, oh, hey, that's categorized incorrectly, or we actually did get that money in. But other times it will be, oh gosh, I didn't realize I was over budget on marketing. Why is that contractor costing me so much money? Or, do I have the bandwidth to hire, right? So it's the insights into those numbers that your business is running on that you're looking for a helping hand with. And I think that is not a once a year tax pro, here's my numbers, do my tax return kind of relationship. And to your point, budget is a consideration there, right? I mean, you do need to consider how valuable that relationship is to you.
Right. What are some red flags that might indicate that it's time to part ways with an accountant or a bookkeeper? Maybe you've outgrown them. But what are some things that should give you an indication that it's time for a change?
Well, I think you can outgrow a professional. I've seen it happen over time. If you've hit a certain success level that you've set for yourself, and you need those more detailed conversations, you need somebody to talk to you. Suddenly you need monthly numbers, or you're looking for a specific set of numbers for a business goal that you have, or finding credit, applying for some kind of contract, etc. And your accountant, doesn't have the bandwidth to take that on. If you're getting to year end and there are a lot of adjustments that have to be made, or you have a surprise tax bill, right? That is a big reason why people come through my door is they will say, I didn't know that I was going to owe, and I owe, and I'm frustrated about it. Now, as a caveat, I will say you're the business owner, keep an eye on your numbers. But I think that is definitely a flag, is that those conversations aren't, the door is not open, right? And then, are you getting notices? Are you paying penalties? Other sort of compliance indicators, that maybe this person is not servicing your business the way that you need.
Yeah, and I think a business that's growing might need a little more hand holding. And so, is your bookkeeper or your accountant or both taking the time to talk to you about what that growth means, because that's how sometimes these larger tax bills happen, is you're growing and you don't have a conversation until the year is over. And then it's too late to go back and fix something, which we're going to talk about in our next segment as well, about why the fourth quarter is important. But can you also there is a thing in terms of why you can't necessarily, always rely on the advice of an accountant about tax deductions, maybe that don't make sense to you. How can that affect you in your annual conversations?
Yeah, sure. So, I mean, when we're talking about tax compliance in particular, at the end of the day, you are signing that tax return saying that, the numbers on that return are substantiatable. You're following all of the guidance around what's taxable and not taxable, what's deductible and not deductible. And, I have heard business owners say, well, my accountant told me I could, or even worse, my friend is doing this, so I did it too. I mean, I think you've got to have it pass the smell test. If somebody is telling you that every meal you eat can be deductible, or that your personal car is a business expense, it's you've got to think hard about what makes sense for your business. And
So it has to be practical, right?
It does, and tax minimization can't be your only goal, right? I mean, you
right.
do have to think about.
And we're going to talk about that more, because we have to take a commercial break, and I don't want to lose that thought, because that will come into our year-end review. What I want you to remember from this is set a budget for the bookkeeper or accountant, for the best you can afford, and recognize the experience you need and the growth you're going through, so that you can get the best services and understand your financial numbers. We'll talk to you in a moment after our break. Welcome back to Balancing Acts. We're talking to Alana McNichol, a CPA and the Director of Tax Practices Services at my firm, CPA firm, Linda A. Hamilton, CPA LLC in New York City. Alana, let's talk about how important it is to do a financial review before the end of the year and what that involves. Why is it crucial to do that in the fourth quarter, and what areas should they focus on?
Yeah, so in the fourth quarter, you're really getting to the home stretch of the year. Most of your results have already come in. So it is the time to start thinking about how you're going to close out the year in terms of your profit, what things you might want to look at to change before year end, whether that is income or expenses. I think that it's important to know where you think you will end up, but also, what are the pieces that need to fall into place to get you there, right? So if you are trying to plan now for something like what your tax burden is going to be next year, the question would be, are you expecting expenses to increase? Are you expecting more money to come in the door? Having these sort of forward-looking conversation is really important in the fourth quarter, because what happens is business owners get to the end of the year and they suddenly realize their profit is a lot higher than they thought it would be, and they wish they had incurred some expenses that they were sort of maybe thinking about but didn't end up executing. So you really do need the runway to have the fourth quarter to do as much as you can to move the needle in the direction that you want it to go.
Yeah, that makes sense. And with that, a lot of times the problem is that they're on the cash basis. Can you talk a little bit about the key differences between cash basis accounting and accrual basis accounting?
Sure. So conceptually, cash basis accounting is you recognize income when you get it, right? When you deposit the check, when the ACH comes in. You recognize an expense when you pay it, right? When you cut the check, when you wire funds out, when you run the credit card, etc. So, it is truly when it happens is what you're recognizing. Versus accrual basis is when you issue an invoice to a customer. That is when you recognize the revenue, generally. When you receive a bill from a vendor, that is when you recognize the expense, generally. Of course, there's a million and one caveats, which we won't get into in this session, but I think the most important point here is that they are significantly different, and you need to understand how you're operating and what that means in terms of how to move that needle if you need to.
Right. And that business of cash, it's the movement of money in and out of your business that's really affecting it. And no accrual, it's whether you got paid or not, you might have income. In particular, it's where the business owners really worry is because you're paying tax on income. If you have another expense, it will lower your taxable income. So that is why it can be particularly important in the fourth quarter. Can you give us an example of how the timing of maybe an invoice or payment at year end can impact the tax liabilities, and any strategies you could use to maybe change that strategy?
Sure. So let's say it's December 15th and you realized you've got to send out a bunch of invoices to customers who owe you money. If you are a cash basis taxpayer, sending out those invoices is not going to impact your bottom line. It is only when those invoices are paid. If you are an accrual basis taxpayer, sending out those invoices is going to increase your income. If you invoice $100,000 worth of revenue and nobody pays you before year end, you are going to have a gap between your taxable profit and the cash that you have to pay those taxes. So you actually do want to think really hard about the timing of things like that. And it's something that does require planning. You've got to think about it, right? Those actions that you take in December, in particular, I think December tends to be on the business in the business time of year for entrepreneurs, right? You're doing things like looking at billing. So just have that tax hat on when you're having those discussions with your team or your accountant.
Right. And I'll throw in another example. If you are cash basis and you send out a bunch of invoices at the end of the year, how many of us now get paid electronically, either by credit card or by ACH? And those business owners that you sent the bill to, they want a tax deduction. So they pay you before the end of the year. And you weren't really counting on having that revenue. Now, especially there are professions like interior designers who maybe give a retainer invoice. You don't want to collect a lot of money if a good portion of that money is going to get spent on vendors or buying materials. So you really want to talk to your accountant about the timing and whether or not you should hold off on that invoice until January if you're cash basis. Because I've seen many, and you have too, Alana, of that happening and throw off all your planning because cash basis taxpayers received money sooner than they thought they would.
Yes, and I think
what about go ahead.
I was just going to say, I think the disconnect between profit and tax and cash can often really surprise business owners. You're saying that I made that much money on paper. Well, I don't have the cash to cover those taxes. So it's it can really bite you.
Another reason to actually understand the story of your numbers, right, is that I think I don't have a profit because maybe I used the cash for something else. Maybe I paid down a loan. Maybe I, did something with a credit line or paid down my credit line, and that can significantly impact your tax basis. We don't expect everybody listening to understand everything here. What we kind of hope is that this will, you'll remember this and you'll speak to your accountants about how does this impact me and make sure that I don't have a large tax bill that I'm unprepared to pay for. Alana, you already mentioned estimated taxes. How does that work with planning your fourth quarter of whether or not you need to make any tax payments in.
Yeah, so ideally you've had these conversations quarterly, right? But I've certainly seen circumstances where the fourth quarter has an unexpected result and an entrepreneur either pays in too much or not enough to the government. And that can hurt, right? You don't want the government holding onto your cash unless they need it. And you also don't want to feel like you've suddenly got to come up with money that you weren't anticipating. So you should be thinking about estimated taxes on a quarterly basis. And that is, again, part of why the conversation with your tax pro more than once a year is really important. You want to have somebody look at these numbers and tell you, hey, consider cutting this check. And I think, again, it's something where the once a year conversation just really doesn't cut it for entrepreneurs. And of course, you're also opening yourself up to underpayment penalties, interest. I mean, we all know how high interest rates are right now. The government is trying to get their money from you in however they can slice it. So yet another reason to really take a deep dive.
So before we end up, are there any things, let's say you do have a large profit and you want some ideas on how to lower that? Maybe it's a home office deduction, maybe it's a retirement plan, maybe it's, is it buying equipment or things that rather than put off? What are some suggestions you work with people on if they want to lower their taxable profit at year end?
Well, the first thing I will say is don't spend money for spending money's sake, right? Lowering your tax liability cannot be the motivating factor in making your business decisions, right? If you truly do need to buy that new asset or take on a new vendor or hire somebody, great. But I think we can't only be focused on taxes. I mean, I've joked about this before, but the way to make paying taxes less painful is to make more money, right? So just don't forget to have the 30,000 feet lens about your business and your financial life. That being said, yes, if you have expenses that are coming up and you can pay them before the end of the year, you should do so, right? One area to perhaps talk to your advisor about is capital expenditures, buying equipment. Those items may not always be tax deductible in the way that you expect them to be. So have the quick call, hey, I want to buy X. Is it tax deductible, right? Because tax law is very nuanced when it comes to deductions in particular. Retirement account planning. Some accounts have to be open before the end of the year. So if you're thinking about doing that, make sure you get your paperwork in. Oftentimes you don't need to fund before the end of the year, but it should be a factor in looking at your year end anyway. So I would say those are some points to bring to your pro for sure.
And how can people find you online or get in touch with you if they want to learn more about your services or any of the things you talked about?
Yeah, sure. So you can find me on LinkedIn. You can search Alana McNichol and I will pop right up. You can also visit our firm's website, which is www.lahcpas.com. And I would absolutely love to hear from you.
Thank you so much. Before I close out, a couple things to remember here. We're coming up on the fourth quarter. This is a great time to do some financial housekeeping. Look at what you think your profit's going to be. Is there any way to reduce taxes if it makes sense? Should you look at a retirement plan? Retirement planning is one of the best tax planning strategies out there for small businesses. Even if you start small, it's something you should talk about. And 2025 is around the corner. We want to make sure that we're getting ready for that as well. Hope you join us again every week on Tuesday evenings for another episode of Balancing Acts.
This has been a Now Media Networks feature presentation.